Welcome to the CMQ Investing Podcast. This is Chris Franco, and this is a special episode because it's our first interview. We've done, I think, close to 90 episodes, and we've yet to bring anyone else on. So this is what I hope is an awesome start to a continuing trend here. We have Brian Feroldi, who is an expert on many things regarding investing. He has a book out right now that we'll talk plenty about, and he has a lot of wisdom to share with us. But Brian, it's great to have you, man.
Wow, what an honor. First guest. That's amazing.
It's big time. It's big time. I'd send you a plaque, but we're not quite at that level yet.
I want a plaque now that you said that.
if this thing blows up, we will get that to you.
Nice.
Trophies like I used to get as a kid playing like the youth soccer leagues. Well, first of all, the question that I want to ask you to begin, I think is perfect, which is, why does the stock market go up?
Yeah, that's a question that truly perplexed me for many, many years. I mean, like many people, when I first started investing, I was eventually exposed to that chart that we see of the S&P 500 and the Dow Jones and even the NASDAQ, right? And what's the chart show? It shows bottom left to upper right. Bottom left to upper right. And if you zoom out and look at the S&P 500, the stock market, the U.S. stock market over a period of decades, it's like crystal clear, right? What happens to the stock market over time? It goes up. However, myself, that just never made any sense to me. Like I understood why the stock market goes down, right? Throughout my life, I've seen the stock market go down during COVID, the 2008 recession, the September 11th attacks, the dot-com bust, right? It makes sense to me why stocks are going down during those periods. What didn't make sense to me at all is why the stock market always rebounded from those god-awful economic times and continually hit new highs. And I'd never come across any book that really explained that concept in details. And the good news about it is it's not a hard concept to understand. I just think there's a general lacking of information out there amongst the public that owns stocks. They truly don't know the answer to why it goes up over time. Hence why I wrote a book explaining exactly that.
Well, it's cool. Well, congrats on the book release. I think it just came out, right? I think
yesterday.
Yesterday. So it's April 6th for anyone who's listening. So that was April 5th. The book dropped. It's on Amazon. And I was noticing on Amazon, you have a review from someone who actually, I would say even before Jack Bogle, I was introduced to the idea of the low cost index fund through, was it J.L. Collins?
Mm-hmm.
Who's off. Yeah. He wrote a nice review of your book. How did you come across him? Like, what's your, tell us a little bit about JL and just sort of how, his philosophy has informed you, or you've informed his philosophy maybe?
Yeah, I've discovered JL through the financial independence community, the FIRE community. I, like many people, came across his stock series that he posted on his website many years ago, and it talks about all the virtues of investing in the stock market. He's a huge believer in just index funds, right? Two simple index funds: one, the total stock market index fund; one, the total stock market bond fund. And it's just a wonderful series for understanding the psychology of investing, why index funds are such an efficient way to invest and build capital over time. So I hadn't met him prior to writing the book. However, the publishing company that I went with is a company called Choose FI Media. They have a very popular podcast in the financial space, and they had a prior relationship with him. So as I was writing the book, authors tend to like talking to other authors. We have so much in common, and I've gotten to know him by providing him with advanced copies of my book. He was kind enough to blurb it and say some really nice things, which just means a huge amount coming from him because he is a very influential person in the space, and rightfully so. His book is brilliantly written, and I think it has done a tremendous amount of good in the world for introducing people to the concept of buy and hold investing in index funds. I think that is a very simple magic formula for building wealth. It's just buy and hold, continually buy a dollar cost average into index funds, and the odds of you doing very well over long periods of time are extremely high.
And I feel like someone like J.L. Collins, and I just remember him from sort of the more blog-centric era where, it's something I know I felt like, I think we met through the Charlie Munger Quotes account on Instagram, but it's taking the wisdom of some of these legends, like we mentioned Jack Bogle, I just mentioned Charlie Munger, and trying to, take that wisdom and format it into these new mediums. And I know on Twitter, you've got a very large Twitter following, very engaged following there. And one thing I remember first seeing you for were these, I don't want to call them drawings. Is that how you probably have a version of how you, like I said, a drawing is a sketch, a diagram. But they're very, they're very simple, but they're very compelling and they catch attention. Can you tell us a little bit about how that came to be, how you just started realizing that was not just a way to communicate these ideas, but sort of a growth lever for you?
Yeah, I like many people, great artists steal, right? They steal ideas from other people, and two people in the financial space that have created kind of simple drawings of their own are Jack Butcher, who runs a wonderful Twitter website, Twitter page called Visualize Value. Another one, Carl Richards, a famous. He's written several books about investing, and like them, they've just conveyed very complex investing thoughts through the power of images. And humans are such visual creatures, right? I think it's like 80% of the information that we take in about the world comes in through eyesight. And I'm a big believer in the phrase, right? An image is worth 1,000 words, or whatever the exact phrase is there. So I'm by no means a graphic artist or anything like that, but I did have some very popular tweets that I had previously, and I thought, well, wouldn't it be fun to kind of take the most popular tweets that I've done, turn them into super simple financial graphics, and email them out to people and give them kind of a reason for following along and joining an email list. So that was the genesis of it. And if you look back at my first ones, they were terrible, right? Like, I wasn't like good at designing, but like so many things that I've done, you're just awful in the beginning and you slowly learn how to suck less. And I would say I suck a lot less now at creating them. But I just think they're a fantastic way to capture attention and get a complex idea across quickly.
No, very cool. Speaking of things that you suck at when you first start, something I think a lot of investors can relate to is, being overconfident and thinking we can pick stocks when we first get going and just having to learn the hard way. Now, I feel like in the last, call it 2 years, we've watched a new cohort come and have access to things like options trading and really learn the hard way. I was listening to an interview with of all people, and I want to talk about her, Kathy Wood, from yesterday, and she was talking about her kids and how some of her kids' friends were options trading through Robinhood, and it was a great way for them to it's a great lesson for them to learn. I was like, maybe there's a better way we can help people learn these lessons than to watch their money light on fire. But anyway, just what are your thoughts on that and just sort of the meme stock? I hate to call it a mania, but that's really what it was. From your perspective, I'd love to get your take.
Yeah, I can tell you when I first started investing, it was 2004. And just like so many of people that have started investing over the last year or two, when you first learn about investing, you're like, great, I want to invest and I want to earn 100% return every month. Right. The idea of just instantaneously taking your money and growing it is just highly appealing to so many people, myself included. That's why when I first started investing in 2004, I was investing in the modern day version of meme stocks and Robinhood. Right. I was investing in penny stocks. We were talking about penny stocks on the Yahoo boards. That was a common place to hear about them. And I did zero due diligence. I didn't even know how.
No, but
you read
the forum, so that's enough.
Right, exactly. It was like here's a ticker symbol to the moon, right? That's all that matters. So like them, I bought absolute garbage. These garbage companies that the only thing that I cared about was the share price below $5, because then I can buy a few hundred shares with my meager savings. And obviously, it's so much easier for $1 stock to become a $2 stock than it is for a $50 stock to be a $100 stock. Shows you just how little I knew about investing at the time. Rightfully so, as you would expect, but by buying garbage companies, my returns were terrible. They were just awful. I lost money. Now, I was lucky in the sense that was the tuition I paid. People that are starting today with options, they're paying that tuition with leverage, and 100-to-1 leverage when you're talking about investing in options. So I'm truly of two minds about Robinhood and meme stocks. On the one hand, I really appreciate that people that knew nothing about investing suddenly are caring about it and paying attention to it. And we can completely thank Robinhood for that, GameStop for that, AMC for that, right? If those things didn't exist, so many people would not be investing in any way. On the flip side, when you start investing, you're gonna make mistakes. I mean, I'm still making mistakes now, and I'm 20 years into this, right? And if you make mistakes with leverage, boy, can that be a really painful a lesson to learn. So I think it's terrible that Robinhood opens up leveraged accounts for people. I think there should be far more levels of education and sophistication that you have to prove before you could even ever touch borrowed money or options or anything like that. Because if you don't know what you're doing, and they're complex, they're really options are complex things, right? If you don't know what you're doing and you buy or sell the wrong thing, or even fat finger, you put one option in, 10 options instead of one, like you could be on the hook for tens of thousands of dollars in a short period of time. So I certainly don't like that aspect of it. So like Kathy Wood, I think they're going to learn a lesson. I just worry that lesson isn't going to cost them hundreds. It's going to cost them tens of thousands.
Yeah. And I don't love the idea that the business model, the business benefits from people learning those lessons, right? Like, if it was pro bono, hey, we're going to donate whatever, we made on this to charity. Not that they would do that, but, I have a tough time with Robinhood for a few reasons. And that's definitely one of them. I think, I've worked so closely with this, in the mobile app space over the years, and seeing not just in finance or fintech, but, the role that gamification plays in creating those habit loops. And when you see those, those same mechanisms put into something like that, like we described with options trading, it really can bring out the worst in us. And especially if you're not, look, if I was 22 with Robinhood, it would have been terrible. I feel really lucky that I didn't have Robinhood at 22, because I feel like it would have made things more accessible. But, the other side of the coin, it has created a certain awareness that didn't exist before. So how do you find, in terms of your, you've seen your following grow, and just your mission is reaching more people now. Are you able to really get a sense of, the kind of age cohorts that you're talking to, or what messages are resonating most with certain audiences, and just how that's evolved over the years?
Yeah, I look at my metrics just like everyone else does. And if you look at the number of the people that follow me, they tend to be between age 25 and 55, and they skew heavily male. That's not by design. That's just what has happened. But I think if there's one thing that I've done right with social media, it's that I've been extremely consistent with my messaging, which is I am a common stock investor. I invest in high quality businesses. I buy them. I hold them for many, many, many years. And in companionship to that, I also keep my personal finances extremely conservative, conservative, right? I have zero debt, multi-month emergency fund. We have multiple sources of income. We have a very high savings rate. So much so that conservatism with my personal finances gives me the ability to withstand enormous amounts of volatility with my stock portfolio, right? If my stock portfolio is down 30%, which I'm pretty sure it is right now. By the way, I think I'm down roughly 30% from my peak in February. Like, that has zero impact on my life, like zero. It could fall another 50% from here, and that would suck. Like, that would suck.
Right.
But my day-to-day life would not be impacted at all, right? That's all long-term capital in there. I can truly just buy great businesses and just let them do their thing. And I am very willing and able to pay the price of owning common stocks. And the price that you pay for owning common stocks is perpetual uncertainty and perpetual volatility.
I like that a lot.
That's the price
that
you pay for owning common stocks. That's a price I'm willing to pay. I am ready, I am willing, and I am able to pay that. It's very common for people to hear that, give it lip service, and say, yeah, I'll do that. And then as soon as their portfolio drops 5%, 10%, they freak out, and they don't know what to do. And it's really then that people learn just how hard it can be to invest in the stock market the right way. So I've been very consistent with that messaging, not because I was like a genius and thought of that. That was after 15 years of trial and error and kind of learning the hard way. So if there's anything for my audience, I do try and always stress long-term thinking, buy and hold, buy great businesses, keep your personal finances conservative.
What's one of the things I like, with content like yours and content like we try to create as well, it's trying to help these really good ideas spread more. And I think, most of the media, and it's not a knock on the media, it's just the business model, it promotes a sort of short-termism that is, it's very entertaining. And, I'll throw on Kramer from time to time and really enjoy it. But it makes me a lot more nervous about, my portfolio and everything I'm doing. Should I be buying these 11 dividend stocks right now? But you bring up a good point. It's something that I think I did an episode about this called like why cash is not trash. And my thesis or my point was, by having a certain amount of cash and emergency savings beyond what I actually even need for that immediate emergency, let's say 3 or 6 months, it gives me a sort of psychological cushion, I should say, that prevents me from panic selling. Because I remember when I was probably mid to late 20s, starting to think I thought I was Warren Buffett. You just load up, you find something you like, load up. And I think Facebook went through some scandal at the time and it dropped 15% in a day. And suddenly all that sound thinking went out of the window. And it's when I really started to appreciate the importance of the psychology of investing. And I think that's just something where you can read everything about it, but having the experience to tie it to really makes a difference. But it's always trying to think, how can you show someone that or help them experience that beforehand? So, they don't have to go through the same bumps. But it seems like, to your point, being a long-term shareholder, it's sort of like we have to pay our dues, like to get to that end game, which is, great compound, the magic of compounding, the magic of compound interest. Realize you do have to go through the ups and downs and be able to take it. Just like you have to go through tough times to get to anything good pretty much in life. But, as far as talking about Cathie Wood, I just want to share, I struggle with Cathie Wood because I like her so much as a person. When I watch her on TV, like, I just feel like I know her, but there's parts I've seen her recently talking about, she's actually promising 50% annualized compound returns over the next 5 years, to the point where I look at, like, is this even ethical at this point? Is it beyond self-belief? As someone who's a little bit more experienced, who's, seen a few more, definitely a few more cycles or patterns than I have. What do you make? Have there been Cathie Woods before? Is she a genius, or is she out of her mind? Is she ethical? Does she believe it? What are your just overall thoughts? Not trying to trash Cathie Wood, by the way, but just trying to understand the phenomenon that is Cathie Wood.
I really like Cathie Wood. I really like what ARC does, what it stands for. I really like that they have essentially open sourced their research, and they put it out there for all to see. And that way, if you think that she says things like 50% annualized returns or Tesla to fill in the blank target price, you can at least see her thinking. Now, I don't agree by any stretch of the imagination with all of the companies that she invests in or all the targets that she puts out there. However, I do like her investing style, which is to invest in high growth, disruptive companies, and she's been right on many of her stock picks. The problem that investors in any of the hot funds of the day get into is they sign up for those funds expecting to earn nothing but positive returns, right? I'm investing in fill in the blank genius. Cathie Wood is clearly smart. Look at the research she does, look at the forecast that she made, and they take that as gospel, not studying the way that actual investing works. If you're going to invest the way Cathie Wood invests, you have to be willing, have to also be willing to put up with occasional periods of extreme drawdowns. It's extreme drawdowns. I don't know the number off the top of my head here, but I would guess that her fund is down 50% from its peak price a year ago. It's somewhere in that ballpark. And that confuses a lot of investors because they're like, well, how can this genius that put up 100 and whatever percent return in 2020 also be down in 2020? It's proof that her style doesn't work, or it's proof that she's whatever negative thing you want to say around her. I think that's wrong.
Insane.
Yeah, I think that's wrong. When you're going to be investing in dynamic companies like the ones that she's invested in, 50% drawdowns are a part of the game. game. It's a part of it. If you look at the returns of any of the best performing stocks of one all time or two over the last 5, 10, 20 years, all of them, without exception, have experienced immense peak to trough drawdowns. I myself have been a shareholder of Netflix for more than 10 years now. More than 10 years now.
Nice work on that one.
It's been an amazing wealth creation machine for my portfolio. But in 2012, when they came out with Quickster or whatever year that was, peak to trough, Netflix dropped over 80%. 80% peak to trough drawdown. And that was one of that was the biggest drawdown, but there were numerous periods when the stock fell 10, 15, 20, 30, 40%, all along the way to delivering just life-changing gains on the way up. But if you're going to sign up, if you're going to own companies like Tesla, like Roku, like Netflix, like some of the genomic ones that she's invested big time in, drawdowns, huge occasional drawdowns are a part of the game. That is how those companies go on to deliver enormous wealth for their investors. My favorite example of that, Berkshire Hathaway. Does it get any bigger, more reliable, more boring, more predictable than Berkshire Hathaway? And yet 4 times during Berkshire Hathaway's, since Buffett's been the CEO, peak to trough, the stock has dropped 50%.
Sure.
Berkshire Hathaway. Sure. Right. And my favorite was Charlie Munger interview in, I think, 2009. I forget what he was doing, but he was asked by the reporter, are you concerned by the 50% drop? But he said, no, like if you can't handle a 50% drop a few times a century, you're unfit to be a common shareholder.
And you deserve, you're unfit. And my favorite part, you deserve the mediocre result you're going to get.
And you deserve the mediocre result that you're going to get. So when I look at Cathie Wood's portfolio in the ARK portfolio today, I'm guessing, I don't own any, let's be clear about it. I'm guessing that she's going to deliver market-beating performance. That over the next 5 years, over the next 10 years, I would guess very strongly that her funds are going to deliver the market-beating performance. However, whether or not those returns go to their investors is another question, because humans are really bad at understanding that phenomenon. And it's very common for people to, especially with hot funds, to put money into a fund after it has a huge rise and pull money out of a fund after it has a huge decline. So I don't know what Cathie Wood's funds are going to do. I'm going to guess double-digit returns over the next 5 or 10 years specifically. However, I'm not as convinced that the investors in those funds will earn the same returns simply because their psychology is going to prevent them from doing so.
Yeah, I wonder, and a question I want to follow up again on Netflix. I wonder with her, I was looking at the chart of inflows and outflows for ARKK, the flagship fund. And it's fascinating because you see as that price was going up, the inflows follow. And so probably the majority of people who've put money in since have lost money, not technically lost money, but they're down. Whereas those people who got in early, I mean, they have a statue of Cathie Wood in their homes. But going back to your experience with Netflix, that's a really interesting, I think, experience, to share with us. How do you know when that 80% drop is a par for the course, or you picked a loser?
Well, that's the tricky thing about investing, though, isn't it?
Because the tricky questions.
Because while every single one of the best performing stocks of the last 10, 20, 30 years has done that, so has every single one of the worst performing stocks over the last 20 years. They've all experienced huge volatility. The only difference is they didn't bounce back, right? They went down and they stayed down forever. My answer to that is that I watch the business. I don't watch the stock. I follow the results of the business. And even during Netflix's dark days of Quickster, right? Like 2011.
And remind us what that was, just so we can get that context.
Yeah, sure. That's a really good point. So prior to 2011, Netflix was primarily a DVD by mail company, right? They started streaming in, I think, 2008. 8, right? It was like a feature that they offered to like people that had PlayStations. You could stream a couple of things through PlayStation, right? It was so archaic. The movies were terrible, but it was a free feature they offered if you subscribed to their DVDs. And gradually they offered it on more devices. The movie got better, the quality got better, but it was still a free feature that was included if you were a subscriber to their DVD by mail business. In 2011, the company made the decision to split those two things off. So you could subscribe to the streaming or you could subscribe to the DVD by mail. But if you were going to do that, and they changed the name of the DVD by mail to Quickster, right? That was the name of it.
Okay.
And doing so, they essentially pushed through a 60% price increase on their customers, where if you wanted to have the exact same features, you were paying 60% more. People freaked out. They flooded social media. Netflix is the worst. Cancel Netflix. They're just greedy, etc. It's a huge negative publicity fiasco for them. And that caused a whole bunch of people, that caused their stock to really drop. And I think that next quarter, they recorded a slight decline in subscribers. It was like 1%, 2%. However, the stock is not the business and the business is not the stock in the short term. And that's why their stock went peak to trough, fell. People thought that the brand was tarnished and the growth story was over. Spoiler, it was not. And if you watch the next quarter, growth resumed. I mean, it was like a 30-day, it was like a 90-day piece of pain. And then gradually, as the company's growth rate accelerated and they started rolling out new shows, and they just won the early streaming wars. Business just picked back up, and the stock got reinflated. But that's just one example of Netflix getting hit. I'm actually looking at the chart right now. Netflix is currently down 47% from its 52 weeks high.
I'd love to go down that path a little bit. So when I remember, it was shortly after 2012 when they debuted House of Cards. And that was after, maybe it was not right after, but I'm just thinking about how that suddenly, that was such a momentum changer and just a game changer. This whole world we live in now is so much based on, the path they started taking, when they went to Quickster and when they doubled or tripled down on streaming, and then with original content, et cetera. But, I'm curious your thoughts on Netflix now, and I'm not looking, to kind of frame this like, should people buy or not buy or anything like that, but more from the phenomenon of, what Charlie and Warren always talk about of having a durable competitive advantage. Seems like in recent years, and not just with COVID, but COVID accelerated it. There's so much more competition, not only for people's attention, but also for just, how many streaming services they can actually have. And I was reading a report that said a lot of people are signing up for one service that has a particular show they want to watch. And there's so little barriers to switch because there's not like penalties for it, that they'll switch off. And, one of their favorite people has a new Hulu show, so they'll go watch that. I'm just curious how you see Netflix continuing to, or if you see Netflix continuing to maintain its leadership position, or just if this current drop off is indicative of the business, or if this is in the case of people just watching the stock.
Yeah, in general, I've seen Netflix go through hard times numerous times in the decade plus that I've owned it. And if your thesis was this is still the streaming leader, the future of entertainment is streaming, and Netflix remains a premier way to play it. And even today, they've tapped out their opportunity in the United States. The United States is essentially a cash cow business that is funding the growth in the rest of the world. So the thesis very much moving forward is continued penetration in international markets. And I forget how many subscribers they have. I think it's 200 and something million. It might be 100 and something million, but I'm pretty sure it's 200 and something million. Well, compare that to the 6 billion smartphones that are out there in the world, and how they can take their content and still personalize it. And another thing about streaming that's really attractive and unique to me is, yes, Disney Plus is a competition. Yes, Amazon Prime is a competition, but just because you subscribe to one doesn't mean you're not going to subscribe to another. So they're not like mutually exclusive competition. But could everything you just say turn out to be true? Absolutely. Absolutely. It could. However, you can come up with any story you want based on the numbers that you're seeing. So I always default back to, well, what do the numbers say? Well,
right?
what are the numbers doing? Is revenue still growing? Is margins improving? Is profits still rising? That's what I'm going to pay attention to, and just know that the stock is going to visit some interesting places in the meantime. If I saw signs that growth was meaningfully slowing, and I have a hard time seeing it ever returning, then I would be like, okay, thesis busted, time to move on to something else. I
Sure.
don't see signs of that yet, especially with what's happened with the pandemic, right? There's so much demand that would have occurred in 2021 and even 2022 got pulled forward to 2020. So that means that their 2020 numbers were phenomenal. Their 2021 numbers were less phenomenal. And it's like, well, what's the normalized growth? We still don't know that yet. I suspect it's still double-digit top-line growth, but we'll have to see.
Yeah, that's no. What are some other signs or other factors you look to say, hey, maybe my thesis is busted? Are there some other criteria you use? I know you're big on checklists. You have a checklist that people can download on your website, which is brianferoldi.com, right?
Mm-hmm.
That's where they can get your checklist. As far as and it's maybe not specifically an investing checklist, but something you would kind of consider as sort of, hey, maybe I need to sell this or consider selling this. What else do you look to as a gauge of that?
Yeah, there's a number of reasons that I would go to look to sell a business. In general, I'm very reluctant to sell anything. I do all my work up front on my investments, and if something is compelling enough for me to buy it, I've learned the hard way that I should just continue to hold it, because let's say I sell 10 things and I'm right about 9 of them. If I just sell one Netflix early, one Microsoft early, one Apple early, then the gains that the losses that I sidestep from those 9 investments are dwarfed by the lost upside from selling that one potential mega winner. So for that reason, I tend to be very reluctant to sell. That doesn't mean I don't sell, but things that I look at to see is the thesis on track. So it would be a few broad categories. One, I was wrong. I misjudged something about the business. I thought it had a moat. It didn't have a moat. Case in point, Grubhub. A few years ago, I was an investor in Grubhub, and they were the market share leader. My thesis was, well, consumers are going to want to go towards the platform with the most restaurants. The restaurants are going to go towards the platform with the most consumers. Grubhub, far and away leader, started the category and everything like that. And profitable, founder-led, checked so many boxes for me. And then a few quarters went by, and revenue growth really slowed, and management had to invest hugely in sales and marketing. And they went from profitable to unprofitable. And management was basically saying, we're investing to fund growth. And I was like, you shouldn't have to. You are the market share leader. Oh, by the way, if you look at what happened, DoorDash was eating their lunch, came in and just took over that marketplace. So that was an example of, I think Grubhub's going to continue to lead. DoorDash said we have other plans. I was wrong. So I sold Grubhub once I saw that.
Well, that's
number 2.
I'll go. Sorry, please go ahead.
Okay, so number 2 would be accounting irregularities. If there's, we have to restate our financial statements, you're dead to me forever, right? Why would I bother? Why would I bother with you when there's 99% of other investments? I don't have to second guess. Are these numbers accurate?
Yeah. Are they cooking the books?
Right. Number 3 would be a mega acquisition I don't like. So if I'm investing in a company because I like a business, and then they acquire another business of roughly equal size, and I don't like the acquisition, I don't mind selling. If you like Teladoc, for example, Teladoc Health, that's one thing. Teladoc essentially merged with a company called Livongo Health a few years ago. It was a massive, massive acquisition. It was like, well, that thesis changing, right? It's a big deal. Number 4, thesis complete with no compelling second act. AKA, I bought the company to take advantage of a market opportunity. Success! The company has really taken over that market opportunity, and there's no second growth lever to carry the top line higher. I think you can make an argument that Booking Holdings is in that period right now, where the thesis was they're taking over the travel industry, and man, oh man, did they. Growth was just phenomenal for 20 years. It's really slowed down ever since, and that was prior to COVID, and that's just like, all right, thesis complete. There's no compelling second act yet, so I don't mind taking some from that and putting it in something else. I have a couple more. Is that okay?
Oh no, I
these?
love it. No,
All right.
I love the passion too. It's great.
Cultural deterioration, Activision, Bobby Kotick, right? When your workers are out there protesting you,
Right.
that's not a good sign,
That was
right? That's something could be wrong there.
Right.
The next company a little bit easier. Company gets acquired, right? If a company gets acquired, I'll sell it. I lost interest in it, right? I just no longer have any interest in following this company for whatever reason. One of the hardest ones is extreme valuation compared to the opportunity. Extreme valuation in comparison to the opportunity. I don't mind paying a mega premium for a company if I think it's captured 1% of its market. I have a hard time paying a mega premium if it's captured 50% of its market.
Sure. And what would you like an example of that just for our listeners kind of, relate it back to?
Sure. So take it to the company that I worked for prior to working for the Motley Fool. I worked for this very small startup company right out of college. I joined them when they were in the R&D stage, so zero revenue, zero FDA approval. And a few years after I went in, we went public. I went back and looked at the numbers now that I know what I'm looking for. And the company at the time of IPO was trading at 50 times sales, had a negative gross margin, deeply negative gross margin, was going to be burning capital for at least 5 more years. The actual number turned out to be 10, and just like an 40 times sales, 50 times sales. You interested?
I think I'll pass.
Yeah, exactly. Right. Well, guess what? If you bought you got a 20 bagger. You had a 20 bagger on your hands. Why? Because the company had only captured a teeny tiny portion of its market opportunity, and it was building out a moat, and it had a great business model, and revenue grew at a double-digit rate, and it's still growing at a double-digit rate. So even though you paid 50 times sales for this business, 15 years ago, the growth has been so strong and the market opportunity has been so big that you have done remarkably well by buying this company. Oh, by the way, that company went down 92% peak to trough along that journey. But it just shows you, or at least it shows me, if I find a small company that has an immense opportunity, I am almost valuation agnostic.
Sure.
Almost
it's
valuation
really interesting.
agnostic.
Yeah, no, that's why I love this space, because there's just the thinking approaches. They're all different, and they all, you have to kind of literally put your money where your mouth is. So it's not like people are just talking, other than, the pundits on TV maybe, but in terms of what we're talking about, this is all, the real deal. What are some big opportunities you see out there? I know, I won't try to influence it with, I was going to say a couple, but just, curious what what opportunities are out there that you think are really compelling right now. You don't have to name companies, but just the actual market opportunities.
Software as a service is probably my favorite place to invest. It's one of the best business models I've ever seen. It's essentially utility-like dependability plus hypergrowth mixed in. I mean, the business model of software as a service company is just awesome. Incredible. The fintech space is really compelling. One of my favorite places to look and find investments is actually the medical device industry, which is an area that a lot of people overlook because they think it's too hard or too complex. I have a bias because the company I worked for that did so well was in the medical device industry, and I saw firsthand just how wide of a moat competitors can build out for themselves. Because it's interesting thing about selling a healthcare product is the people that use a medical device are the doctors, the nurses, but they don't pay for it. So they're not. Right. They have zero economic incentive, often zero economic to change.
That's a great insight. Yep.
And it's the health insurance and it's the patients ultimately that are paying for it. So it's like trying to convince a doctor to stop using Windows, stop using Excel, right? It's that hard to get them to try something else, and if there's no economic reason to do so, good luck selling your device. So if I find a company that is innovating and growing really fast, that tells me they have something really special going on. And when you combine the barriers to entry for the FDA, barriers to scale with access to doctors, with training, it can be a wonderful place to invest. So those are 3 areas that I have a bulk of my capital put in, amongst many others. But wonderful thing about investing today is there are literally dozens dozens of innovations that are happening out there in the world, and you can probably make a fortune in many of them. Like we've seen in the past, though, many of those promising technologies will flame out and won't deliver returns for investors, but opportunities galore even today.
No, absolutely. And I think, for especially younger investors, and I, consider myself in, kind of in this in-between stage, but you can find something where you're just passionate about it. And even if you don't find an investment, you learn a lot more about how the world around you works. Something about, I know you mentioned with medical devices, I just had an idea pop in my head that's, fintech. So this leads us to the ultimate question, which is not actually the ultimate question, but why does Bitcoin go up?
Yeah, great question.
That's
Bitcoin would be a tricky one.
That's your sequel to your book.
That's not something I've tackled yet. However, I will say this about Bitcoin and Ethereum and crypto. For many years, I was completely against it, right? People would ask me, what do you think of Bitcoin? What do you think of Ethereum? And I was like, no cash flow.
Right.
Can't value it. End of discussion. It's digital gold, right? I just completely wrote it off, much to my demise, because it's up, I don't even know how many thousands of percent since I poo-pooed it as an investment idea. More recently, I've changed my thinking about it, and I did so because of this question. I asked myself, should there be a digital currency of the internet? Should there be a digital currency of the internet? I think the answer is yes. The more I think about it, the more I think the answer is yes. Okay, so if there should be, what's the top dog and first mover and leading contender to be that thing right now? It's Bitcoin.
Right.
Does that mean it will always be? No, right? Could there be another cryptocurrency that comes along that displaces it? Of course. Could the whole crypto thing disappear? Of course. But I view the world through the United States bias, right? Everything I know about the world is from living in the United States. I've never had to deal with massive currency devaluation, with getting money out of the country, with trying to remit payments. That is something that a lot of the world has to think about to deal with, right? From that perspective, when you compare the currency in like Zimbabwe to Bitcoin, Bitcoin looks like a safe haven. Right? The currency there is nothing, or paying huge fees to transfer money from one country to another. The idea of doing that through Bitcoin also looks like a safe haven. So I own a tiny little bit of Bitcoin. I plan on buying more over time. I see nothing wrong with making it a small part of your portfolio, assuming that if it doesn't work out and it goes to zero, that the rest of your finances will be okay.
Yeah, the approach I took, several years ago, I thought I was, the king of the world, and maybe was it 2016 or 2017, and got to experience that kind of rapid rise and fall. And thankfully, I didn't. Actually, I heard a video with Charlie Munger talking about, one of the toughest problems with something like that is if it works, it can be almost worse, because you'll end up falling for another thing like this, and because you think you're smart. And at the time, I remember I watched a video. He said that, and I sold all my Litecoin. I bought a lot of Litecoin, so that the profits from that offset the panic feeling of the crash of Bitcoin at the time. So I held on, but I sold my Bitcoin. And I think I was at about 50. Yeah, it was at 50 is when I sold, and I still held on.
$50?
50,000.
Okay.
Yeah.
I was like, that'd be painful.
And that's our podcast. Thanks so much for listening. I'm gonna go cry in a corner. But no, so I held on to some Ethereum, but at the time anyway, the issue I was having was I'll never know when is the time to let go of this, because like what you said earlier about, you're looking at the business and not the stock, and you can look at those numbers and see if the drop is deserved. There's nothing there I can really gauge. And of course, I've tried to read as many of the investing classics as I can, and not all of them have like this anti-crypto slant, but I know A Random Walk Down Wall Street, the latest version, does a really good job of going through all the bubbles. And then I read The Crash in 1929, a couple other books like that. And, it could just be availability bias, but it just was like, this reminds me a lot of what I'm seeing right now. I feel very strongly that, digital currencies are here to stay, and that we're in the early stages. I think blockchain is game changing and will continue to change the game. I just have a tough time with trying to get my head around, okay, but why is this going up, other than just someone thinking they can sell it to someone else? Especially with the lack of utility, it seems like with Bitcoin. I've been disheartened by, the fact that I have to incentivize someone to mine it for me and pay them these fees. And again, I'm not anti-crypto, I'm not anti-Bitcoin, Ethereum, or anything, but just willing to kind of challenge the assumptions. And a lot of people my age are just like, totally, they don't see any of those other arguments. They're just like, nope, this is it. And I read there's an Investopedia survey that I was reading last night. There was, I don't want to reference it without a full citation, but the gist of it was that, the younger generations, I'm a millennial, so then Gen Z, are looking to retire much earlier. They're expecting they'll retire much earlier. And one of the big reasons is crypto. It's going to help them, get to retirement faster. Now, that'd be awesome. I never root against that, but it makes me a little bit nervous that that's the expectation. So, we'll see how it goes. It's really fascinating though. I think it brings up so many interesting points about, what is value. And like you said, this is, at one point it's like, well, this doesn't have any cash flow. So how is this? It's not a productive asset. So what is it? But it's definitely fascinating. One last thing we talked about, you mentioned you're, looking at the world through the USA lens, and I'm definitely, right there with you. I have become a recent year or so, much more interested in what's going on in China, in part because Charlie Munger is always talking about China, in part because through Charlie Munger, learned about Li Lu. But a lot of our community, we're all in sort of a serious but also joking manner. We talk about Alibaba like it's our personal Dogecoin. It's like, I'm not someone that wants to look at stocks all day because I think it's unproductive, but every day almost, I'm like, hey, Alibaba's not looking good, just to kind of, it's fun. And it's an interesting topic because people are so polarized as to what their take is. But just curious on if you have any strong opinions about, what's going on in China or the investing opportunities there with some of these very dominant companies that there's a lot of geopolitical uncertainty.
Yeah, it's a very tricky place to invest because, to your point, there's so much happening behind the scenes that I just don't know and can't think about. On my YouTube channel, I recently interviewed someone that spends a lot of time thinking about investing in China, and he really opened my eyes up to some of like the mindset that's happening with the Chinese and the Chinese government, and just how they think completely differently about capitalism and shareholders and structure than we do in the United States. If you've ever analyzed Alibaba's business, it's a complex business.
Yes.
I mean, there's a lot
there
going on there. I did a hour-long deep dive into the company on my YouTube channel, and one of the criteria that I used to come up with risks for investing in a company beyond geopolitical, beyond valuation, beyond customer concentration is just how hard is this company to understand. And it's a hard business to understand. There are multiple business segments that are going on in there. I mean, to be fair, Amazon's a hard business to understand. It's not just an e-commerce site, right? There's a lot of things that are going on underneath the scenes when it comes to big tech companies. I mean, Facebook's easier. Even Apple is easier. Amazon's hard. There's really a lot going on there. So I ended up saying Alibaba Group, I think, could be a wonderful investment. Very strong business, very profitable, growth opportunities galore. Lots to like about them. However, that's a company that's worth $300 billion today, $300 billion. Is this, so for me to invest in it, or really have to be really interested in it, I have to ask myself, is this a $1 trillion idea? Is this a $2 trillion idea? Is this a $3 trillion? It has to be a $3 trillion company to 10x from today. Could that happen? Certainly could. It certainly could, but I would rather focus my time and energy on companies that are between 1 and 50 billion, because
Sure.
I think they have a much easier time of becoming a 10 to $500 billion company than Alibaba does. It's also surprising me that this is such a popular name in the United States with so many retail investors, because we're never going to become customers of it, right? We're never gonna be users of the technology, but a lot of people really like it. So if you were just to ask me, do I think it's going to beat the market or lose the market? I would guess beat to the market, but I think it's also a very complex business.
100%. I think what I found, in my over the time I've been putting into it, and this has been a lot of time, but the number of other businesses within it, like in the logistics side, there's just so many other intricacies to it, and I think you can get almost lost in that, to where I think it's I can only handle so many companies like that, or at least I think I can. On that same note, though, I think it was in Bill Miller's recent letter, he was talking about there's companies that are selling at 50% below their 52-week highs that can offer some interesting growth opportunities. Now, obviously, I would never say that that's, a bulletproof strategy by itself, but it's always fun to kind of go in the stock screeners and look at what's really beaten down from a 52-week high that has some strong characteristics. And just curious if you have any takes on, a company like PayPal. And just from what you've seen, you've watched that company evolve over the years. Do you feel like the best days are gone, or does it still have, some wind in the sails, so to speak?
Yeah, PayPal I'm far more interested in. I think PayPal is a fantastic business. PayPal, that what's happened to their stock price is very much a management screwed up with communications more than the business. The business is really floundering in some way. I mean, it's still growing. The company is very much still growing today. Wall Street thinks it's going to grow 16% revenue this year and 20% revenue next year. This is still very much a company that is growing its top line aggressively. It's free cash flow positive. It's buying back stock. I think it's got a pretty wide moat, and it's trading today at a far more compelling valuation than it has in the past. And I think that's an important point to point out. A business like PayPal, a business like Alibaba, a business like Microsoft, big, mature, profitable. They're past the hypergrowth stage of their business. Companies like this, when I'm interested in them, I put valuation. I put much more emphasis on valuation. Much more, because the upside potential is so much more limited. That valuation, it really makes sense to hone in on valuation. Conversely, again, if a company is $1 billion, $2 billion, $3 billion, $5 billion, even, and the potential is huge, I really de-emphasize valuation. So PayPal is a stock that I like very much where it is today.
And Brian, how much time do we have? I want to make sure I'm mindful of that too. So I
got about 10 more minutes if that's cool. Assuming Zoom doesn't kick us off.
No, exactly. Speaking of, what do you think of Zoom? That's another company that's
shareholder
beaten down.
I've bought it I think Zoom is an incredibly high quality company.
Yeah, I have to say I've become, and I try not to fall for the trap of just, falling in love with the company because I like using their product or service. But, is again, another one that's been beaten down a lot, but I think what they're doing in telecom, or at least I've not gotten to a point where I'm ready to invest. I have a lot more research to do, but as far as all these, like what we're doing right now with video conferencing, it's just the most reliable. I think the brand wise, reliability with any sort of software like that really builds loyalty among customers, and it becomes indispensable. So, and I thought probably, if you asked me 2 years ago, I'd say like, there's no chance Google Meet, like everyone has Google, kind of that simple thinking, but it's fascinating. How about a company like Peloton? I'll just tell you my thoughts on it. I said Peloton's like the new Bowflex. Like there's always this exercise fad. And I remember as a kid, like in the 90s, like someone's mom would have like the new Norditrack or the Bowflex. And, eventually it would become like a bona fide Swiffer, just collecting dust in the basement. But that was a company where it seemed like the narrative got just so over the top about how big it could be. But, maybe I'm wrong, and I definitely don't think I have all the answers, but just what's your perspective of a company like that? Just looking at it from the top, like 30,000 feet, so to speak.
Yeah, when Pinterest,
Peloton, you're like, I'm on a Peloton right now. I'm actually riding a Peloton bike.
When Peloton first came public, my very first thought was pass. Just hard pass, right? I have no interest in buying exercise companies. One, because they can be faddish. No interest in buying super expensive one-time purchase businesses, which Peloton very much is. But the growth was certainly there. I did dig into it more, and I was like, the company was profitable. It was growing quickly. It was run by founders. It has a very strong brand. It had a bit of a network effect going on where the people that are on there, I know people, and I saw the usage statistics. Like at one point, the average Peloton user was using it 29 times a month. Yeah, that's every single day.
It was really impressive.
On average.
Right.
Yeah, that's incredible.
Right.
That is incredible. All right. So I was like, there's something here. There is something special going on here. So I gave it the thumbs up. I never owning shares, but I became a Peloton bull. And then, of course, the business model ended up showing through, right? If you're going to be selling $4,000 equipment and that's 90% of your revenue, eventually everyone that has a Peloton is going to already have one. And the software part of it is the compelling part to me. But that's only like 10% of revenue, 12% of revenue, 15% of revenue, something like that. So that business, the software, the subscription, highly attractive, but that's 10% of the business.
Yes.
So Peloton, there is a business here, right? This is a viable long-term business. Well, whether it's a great investment, completely different question.
Are there any categories of, whether categories or sectors that you just avoid out of general principle or from experience? I know for myself, I don't go near like fashion retail, just
Yeah.
because I've learned it's so hard to predict the trends and styles, and it's a messy business, and I've seen those businesses a lot up close in my, through my company. They can make good cash for a period of time, but again, they can get stale quickly with consumers. It's just a lot of, it makes it very difficult to predict the future. But just curious, any of those for you?
Yep, ditto. Fashion, retail, really, really hard. Anything that I think is about to be disrupted, I just completely avoid.
Sure.
There's no valuation on ExxonMobil that would make me say yes. Like there's none. I have no interest in oil and gas and anything fossil fuels because I think they're being disrupted, and I have no interest in them. Chemical makers, don't really know them. Aerospace companies, don't really know them. Banks completely different analysis on a bank than it is on a growth stock. So it's just a different mindset there. There are a couple of sectors that I'm just going to completely avoid: materials, anything that relies on commodity prices, anything that sells commodities, because then it doesn't matter how good the company is. The only thing that matters is the price of the commodity. Right?
I was fine too with materials. That's a great point. With materials, I just know, and maybe one day this will change, but if I can't get excited about reading through these 10Ks for a certain, like something like that, I know I have no shot of getting any insight that's going to be better than anyone else's. Like, you're just realizing that I have to be really into it to have any chance if I'm going to go the individual stock route. But no, that's just a really good point to bring up. As far as you mentioned, what we were saying with materials, and then before that, I think it was, what about companies? I know, had some people, oh, actually, I know what I want to say. Hold that thought. Occidental. What do you think Warren Buffett's up to? Loading up on Occidental. I mean, that would technically fit into the criteria of something that could be, disrupted in the coming years and decades. Do you think it's the oracle at work? Is there a bigger picture at play that, my pea brain doesn't quite, understand?
I would say, I don't know. I've done zero work on Occidental. I can tell you I have zero interest in it myself. And people think when Buffett buys something that it's like automatically going up and automatically like the greatest thing ever. Warren Buffett has bought plenty of stinkers.
Right.
Plenty.
Right.
IBM, just in recent years, he admitted he also overpaid for precision cast parts. Even Berkshire Hathaway. Airlines. Very mixed history with. None of that matters though, because he's bought several, like 10 phenomenal businesses, and he's held on to them for decades, right? So it doesn't matter how many stinkers he buys. So when it comes to, some people pour over his buys and his sells. First off, I don't know if it's him or if it's Ted or Todd that's doing the purchasing. But with a company like Occidental, that it's hard pass for me. I have zero interest myself, but who am I to say that's going to be I'm not saying it's a bad company. It's just that zero interest from me.
Yeah. And I always say to people too, they have like a guy like Warren Buffett or Berkshire Hathaway, rather, it's, what they're trying to achieve and what they're working with and their risk tolerance and everything else that would go into anyone's investment decision-making. It's very different than, someone like myself is just, sitting and talking on Zoom right now, like it could be part of some bigger strategy, or like you said, it might not work out and he's taking that bet. I think one of the best lessons I've learned from Warren Buffett, or his success rather, is just the importance of avoiding any huge catastrophic mistakes. To like never put yourself in a spot where you can't live to see or fight another day. And so I think I was reading an interview with the CEO of, I think its last name's Flat. He runs, Brookfield.
Bruce Flat.
Bruce Flat. A great interview with him in Bloomberg from yesterday. He was saying, in order to have, compounded returns at 17% for 20 years, I think something along those lines, you can make little mistakes, but you cannot do it if you have a big mistake. So on that note, you just want to, kind of close things out here. It's so great talking to you, by the way. Really appreciate your time. What has been, what would be for a new investor, what would be one of the biggest mistakes they should avoid other than trading options on Robinhood?
Yeah, no, that'd be number one. Avoid that. Avoid that one. People mistake that I see people making, especially new investors, is they're in a rush. They're in a rush to build wealth, and they're so blinded by dazzling, huge returns that it overwhelms all other senses. As I said before, the reason that I have the vast majority of my wealth in the stock market is because my personal finances are so so conservative, right? I spent a lot of time upfront investing in my career. My wife is investing in her career. We've paid off all our debts. We have a very high savings rate. We have multiple sources of income in. We have done everything possible to make ourselves as financially bulletproof as we possibly can. That affords us the luxury of being able to invest aggressively in the stock market and affords us the ability to withstand huge amounts of volatility. If you're not in the same position as I am, focus on your career first. Focus on your savings rate first. Focus on your personal balance sheet first. Because if you're banking on 30%, 50%, 100% returns to buy a house, buy a wedding ring, go on vacation, whatever it is you want to do, I mean, you're going to take some unnecessary risks, and then something bad's going to happen eventually. So don't be in a rush. All wealth building takes time, right? You have to just recognize that it takes time. So focus on that.
No, it's a great lesson. I think just in general, I think people lose sight of that, which is that, you get your affairs in order, before you're overly concerned about what's the next, the 10 or 20 bagger to find, make sure that you've got your own stuff locked down. And I think, some of the greatest investors, they all have that sense of frugality. It's like they recognize the value of a dollar and they don't grow on trees. On that note, in terms of, people can get your book on Amazon. I know we mentioned your website. You can find you on Twitter. Where else should people check out your content? Just, do all your plugs.
Yeah, the best way to connect with me is on Twitter. I'm at Brian Feroldi. I'm most active there. I also have a YouTube channel. Also, my name, Brian Feroldi. If you're interested in anything to do with stocks or individual stock analysis or my checklist. But yeah, the thing that I'm most excited about is my book, Why Does the Stock Market Go Up? It just launched yesterday. It debuted #1 in Amazon in the investing category. So I'm really pumped about that. But that is like the bare bones basics of what I think people that know nothing about the stock market should learn in order to be able to do well over long periods of time. I really think that's going to be the best thing I've ever created in my career. So I'm really excited to see what people think of it when they get their hands on it.
Well, I'm going to go ahead and make sure once we're done talking here, I'm going to order it just to show support, and I'll definitely give it a read.
Thanks.
Definitely recommend everyone who's listening checks it out as well, because I know you're you're one of the people I was always on kind of the search for people like this, where it feels like, where your point of view and your perspective, it's coming from an earnest place. I don't think there's you're not promoting some fund where you get some big expense ratio. You're actually, spreading good messages. And I think that's important that we can, in our little way here, elevate that as much as we can. So
totally. I'm a big believer in mission statements, and my personal mission statement is to spread financial wellness, right? I'm super passionate about teaching other people how to do better with their money.
My mission statement is to just, buy as much Alibaba as I can and just
go
down with the
also
ship.
A great one.
Yeah. Well, Brian, thanks so much, man. It's been awesome having you. And thanks for being our first guest. Thank you for listening to the CMQ Investing Podcast. And if you haven't already, make sure you subscribe on Apple Podcasts or Spotify. It's totally free. And that way you'll receive every new episode as soon as it's released. Thanks again, everyone. We'll talk soon.